Dr. O, you write a column every week in the Center Square. It's the Everyday Economics column. It's a place where you look ahead at what might be going down in the week to come. And you start with an interesting note from Fed Reserve Governor Christopher Waller, who is, I think, winking at the idea, at the very least, of a rate cut. And I won't put words in your mouth because you do a fine job of that yourself. What do you make of Christopher Waller's thoughts, my friend?
Yeah, well, first of all, I think he's the best person to speak on monetary policy. In terms of board governors, but voting members of the FOMC. He's published extensively on monetary policy. And when Waller speaks, markets listen. People pay attention, and the way he broke it down for everybody was basically, look, the tariffs are going to be potentially large one-time price increases that will cause inflation to rise a little bit temporarily and recede fairly quickly. So you're going to get that big increase and then you're going to have that kind of slowdown, right? That, right? And so depending on the size of the magnitude of the tariffs, that's going to determine the increase, right? How much of an increase we see in inflation in the near term. And so basically that's what's going to happen. The tariffs are also, they act as a tax on consumers, on businesses and consumers. And so of course that has a negative impact on aggregate demand, slows down economic growth. And I think Waller understands that the labor market is really poised to weaken further. Look, the last jobs report we got, half of sectors were actually, only half of the sectors were responsible for the job gains that we're having. The other half were actually cutting jobs on it. And so the labor market has slowed and continues to slow very rapidly. And I think the Fed should get ahead of this. And so Waller is suggesting that potentially a rate cut is not a bad idea, right? If there's so much uncertainty about the impact of tariffs, and we know the labor market's cooling, and inflation, by the way, is just a hair above the Fed's target right now, then why not preemptively get that rate cut and then pause and wait to see what happens?
Okay. And so that's you used the exact word that I was going to put to you in a question, preemptive. And so there's not a lot of tea leaf reading required here. Tariffs, when enacted, not if enacted, when enacted, there will be tariffs, right? We know that there is going to be some net effect of that. So how far in front of potential tariffs can the Federal Reserve go? And what would a reasonable cut look like? You say a 25 basis point cut in the column this week. Is that as far as they'll go up front?
Well, let me just put it this way. Tariffs have already been enacted. Yes, there are some pauses here and there, but tariffs have already been enacted. It's already playing itself out. You're seeing an uptick in goods prices already. And so we're already seeing that. And so with the downside risks to economic growth in the labor market, I think it's reasonable to say that we could use, the Fed shouldn't wait and see and be too late on this because it will cost a lot. It will cost so many Americans their jobs. And so I think the best case scenario here, the best course of action is probably to cut once and then to wait and see, right? If we're uncertain, but we know there's a huge amount of downside risk, then it's probably better to play it safe, right? And I think that's how I refer to it, as I call it, playing it safe. Cutting once and then waiting to see what ends up happening. It's pretty clear that if tariffs represent a big one-time price increase, then ultimately inflation will rise in the near term, but will come back down fairly quickly. And ultimately that means the Fed can actually afford to go ahead and cut rates.
Right.
Inflation expectations have been fairly anchored. Even if people start to see price increases, it's unlikely they'll be able to go ahead and negotiate higher wages. And which means it's very unlikely that we'll get a wage price spiral. And so the Fed doesn't have much to lose here by playing it safe, right? By cutting once in July and then waiting to see what happens after July, right? I'd say the risks are skewed to the downside. And so I would, at least that's my assessment. And it doesn't seem that Governor Waller's too far away from that assessment.
So PCE data comes out, on Friday this week. I know that's like you labeled that in your column, the big event. What are you looking at there? What do you think is coming? Let me throw you a data point real quick if I can.
There's a couple of things I'm going to look at PCE. I want to look at the savings rate. I want to see whether or not consumers are saving at a higher rate. And if consumers are saving at a higher rate, remember consumption is the bulk, right? The largest chunk of economic growth that makes up that adds to economic growth. And so if consumers are pulling back, then we're slowing down, right? And so that's what I'm going to be looking for. In terms of the price index, right? The Fed's favorite inflation measure. What do I expect to see? I expect to see some goods inflation uptick, an uptick in goods inflation. But we should see kind of everything else coming down, right? Of course, we got the latest, crisis in the Middle East. Fortunately, that could potentially cause oil prices to increase, but that will not be reflected in this month's PCE.
Right. And we're going to isolate and we're going to talk about that separately. There's a reason why, obviously, we're taping this on Monday, June 23rd. There was a lot of news that happened over the weekend, with regard to Iran and Israel. We're not ignoring that. We're going to hold that in isolation. Hey, real quick, when like in the acronym PCE, personal consumption expenditures, we're talking about like literally everything that people would spend money on, including services. So like your car breaks down, or if you not only need a new tire, but you need that tire to be balanced, or, something like that. I mean, that all factors into that heading of consumption.
That's right. That's what we're looking at. And it's nice because we also, in that report, we also get to see personal income, right? So on aggregate. So how much incomes are increasing and how much consumption is increasing, right? And so you could actually kind of tell what the aggregate savings rate, on aggregate, how much of our income are we saving as a nation? That is included in that. And it gives you a good picture. I think that's it gives you an idea of what's going on, at the aggregate level. And potentially, right, of course it's skewed, right? People on the lower end of the spectrum are probably saving a lot less and are probably very squeezed right now compared to people at the higher end of the income distribution. And so it's, so you can't completely rely on it and say, hey, the economy is doing great. But you get a sense of what's going on average.
So, I mean, a lot of people, obviously, that watch or listen to the show, they know of your work at Zillow. They know how you focus on the housing, market. You pulled out some data points I thought that were kind of interesting. We'll make this the last topic that we touch, about, sort of home values rising and falling in certain metropolitan markets. I thought this was interesting because, it seems like the markets, where there hasn't been a tremendous amount of growth recently, talking about longer term, decades, Buffalo, Cleveland, Milwaukee, Hartford, Pittsburgh, those numbers are up. And the numbers that are actually kind of headed down are the markets that have had tremendous growth historically in that same period of time. San Jose, Miami, San Francisco, Austin, and Orlando. nothing really terrible. There's not crazy decline there. I mean, the greatest of them would be San Jose at 0.8%, and Orlando's on the chart at 0.1%, right? But what's to that? I mean, for the benefit of the folks that are listening and watching.
Yeah, well, look, you have relatively affordable markets that don't build a lot of housing. And so some demand, even, demand growth exceeds supply growth, then you're going to get some pressure, so upward pressure on prices. And that's essentially what's going on in the Northeast of the United States. Whereas in the South, you've had a big increase in supply with new construction coming on the market. In some markets, you have sellers, existing homeowners coming back on the market, inventory much higher than it was before the pandemic. And so in those Sun Belt markets, price growth is slowing rapidly. And in some markets, prices are actually down when compared to a year ago.
Yeah. Appreciate your thoughts as always.